Hello there, welcome to Believer Trader, and we are today discussing about a basic options chain. Okay, so in that situation, we are learning very basic things like what is delta, what is theta, what is gamma, vega, everything about it. And especially, so many of you lag in understanding the option chain, whether open interest is going to be alive or whether it's a change of OI is going to be make a huge difference when you're trading. Yes, of course it does. Okay, and with that, whether we have to combine our technical chart, yes. So on that all the questions we are coming with the option chain analysis, and that will cover complete option chain and with all the details like what will be a major agenda here. Let me show that major agenda what I'm going to share here. So these all things what I'm putting here. The starting point like stock market basics, like what is the future and what is few options, and how the derivative contracts have came into the picture. And then after that we are studying about options basics, like what is call, what is put, and what is the in the money, at the money, okay, and OTM. Okay, these all are the confusion zones till now. So many people's, even though if I ask anybody that, yeah, what is the in the money options if market is trading at 25,700, they'll then they say that, no, I don't know, like that. So that situation makes you tricky when you're taking a position. So I want that you have to know very basic thing about in the money, at the money, OTM, either side, like call side or put side, because you have an option chain where you can see the both side and you have to decide it. And on that basis we are studying on open interest analysis, what is actually open interest, which are not yet closed and they are open in the market and they play a real role in the market. So all those things, and with that we are studying about like implied volatility, delta, theta, vega, gamma, all those things. And I personally tell here which are the very important constituents you have to look into, so that make you a better trader. So on that basis, VIX and IV, that comparison, and what's a max pain theory, how actually strategy going to be built. Okay, so many people in the market, they'll tell you that, yeah, Greeks is not so important, and by learning you'll not get anything. See, by learning, okay, this is our brain where we are using only 1%, not only 1% at all. And if you are putting a 0.2 to 1% also, that's not makes you a big difference. Learn it. If you don't like it, definitely you can skip it. Okay, so with that we are going to study or start with one first basic thing with practically what is option chain, how it looks, and what all the things we are going to learn here. So let me share screen, new one here. Okay, so we are here to understand what is option chain. So I'll put it to Nifty to understand what is option chain. Right now market is has closed around 25,700, and if I click option chain, if I click a right click, and if you are in broker, you have to check which is that it is giving you. Okay, so I'll use a pen to show you that where is a option chain. See, these are all the things you are seeing it out here. Nifty 50 is underlying. Okay, Nifty 50 underlying, and what is a this is you are seeing the right side expiry. So we are seeing that 20th October is expiry here, and after that we are seeing so many expiries here. 28th October, 4th November, 11th November. Yeah, obviously we'll see a open interest highest level at present expiry, because so many people play into the option selling mode, and so many people even think that a cheaper option price so that I can buy at a cheaper value. So all that basis, let's start here, understand here. Number one point, so future price is running at 25,751 and spot is 25,709. And usually so many people will mislead you that saying that, okay, you have to see future chart rather than option spot chart, because on that basis only market runs. But as of now, you can see the market is right now at 25,709. Why these people has to show 25,709 as a spot value? They could have shown 25,751. So do understand that's not right. Anyway, so understand here on the both side we are seeing this side is a call side. Okay, everybody can understand this is a call side and this is the put side. Okay, in that situation you understand right now market has closed around 25,700. Okay, so when market is standing now, okay, where is stopped here? 25,700, very nearest value. And for this one we are calling at the money. For call side or put side, you understand here, this is a at the money. Where market stands, that is a at the money. If market could have stopped around 25,800, this could have become at the money. Okay, anyway, you understood what is at the money. Okay, this is at the money strike. If anybody asks you what the at the money strike is, 25,700 for the call side, which is trading around 89 rupees or close. Last trading price was 89 rupees. Whereas if anybody asks you 25,700 put, 70 rupees is a at the money. Okay, and you are seeing some changes here, change in percentage. Okay, and this side also, and market rallied upside here, so that's why you are seeing call. Okay, change in open interest, like change in percentage around plus only. And as you can see, focus here, so to understand better here this side LTP change percent is negative, here is positive because market rallied upside here. So before that, anybody don't know what is a call or what is a put. So for that purpose, I'll start up what is a call, what is a put. If anybody asks you that, yeah, what is a call or a put, and everybody know about it in market. If market goes upside like this, okay, everybody know that in the market they are randomly, they are going and they are buying a call, because market goes up, I have to buy a call, and market if it goes downside, I will to go buy a put. Simple. This is common sense, everybody does it. Very nice. So if market is going upside, means call buying is good, and that situation, what will happen to the put? Whether it will stay same or decline? Yes, of course it declines. So what to do in that situation? Yes, of course you can sell the put also in that scenario. Okay, and the scenario can be different based on the IV value and based on the time also. We will discuss in the coming scenario. Okay, anyway, right now market is going upside here, so you are going to go for call buying or put selling. If market is going downside, so in that situation you have option that you have to buy a put, obviously. Okay, market goes means you are going to go buy for the put buying, or you have a one more option, that is call doesn't stops there only, it will decline, go and sell it. Okay, you have a two options, either go upside or downside here. So you got to know what is a call and put. Okay, so you got to know about what a call is put, and let's start again option chain. Let me clarify here. This side, left side, you are seeing this is a call side and this is a put side. Okay, right now market has closed around the 25,700, and the where market is closed, for that I'm talking about, it's at the money. And before market reaching to 25,700, it has traveled all along 25,400, 500, 600, some 100, and it is just covered all this area before it reaching this area. For already covered area is called as in the money. I repeat this word, in the money. Why? Because market before coming to this area 25,700, it has carried, like it is covered even 25,000, 25,100, 200, 300, 400, 500. All those areas covered. Already covered area are called as in the money. That's it. Otherwise, you can see that 25,700. What is the at the money? Okay, below whatever the prices are there, okay, strikes are there, they are all the in the money. For that purpose, we call them as a ITM 1, ITM 2, ITM 3 we call. Okay, and where market yet to travel, I repeat here, 25,750 yet to travel, 25,800, 900, 600, 26,000. These are all the levels yet to market to travel. So this is market where it has to travel now. So these are not yet covered. So they are out of our reach. So they are called as OTM. That's it. Simple. Yeah. So next, in case if you are learning on the put side now, come here. This is at the money as common for the both. Okay, call and put side. Okay, market fall. Okay, market has fallen from the top. If I say that the 26,000 to 25,700. See, market already fall from 26,000, 2,500, 2,500, and right now this is a situation where market is standing now. So already covered area, they are called in the money. Okay, and where market has to fall now, it's not yet fallen. Okay, this is yet to fall. So this area is called OTM, out of reach. That's OTM. That's it. Simple sense, right? Super, very nice. You got to know what's at the money, in the money, okay, and out of the money. You got to know. So in case market, see, understand very simple sense here. In case market travels from 25,700 to 25,900, in that situation, 25,750, 800, 850 are going to be covered. In that situation, these all area will become again in the money. Yep. So in case market fallen, like it has become a bearish trend and the market fallen, market gone to 25, 500 then. So these all area are now out of the area. So they are came into the OTM areas again. So this is how the ATM, OTM, ITM switching are going to happen. They are not going to be constant every time. You should understand it. And every time you should see whether you are on what side. You have to think. Look here, simple. CE means you are going long. P, you are going short. Simple. You got to know everything here. And in the structure, you can understand here. This side you are seeing open interest, and this is LTP. Okay, last trading price, CE. Okay, these are all this what you're seeing here. These are strikes. And why we call option chain, I repeat here, option chain. Why we call option chain? Because simply see this, these strikes are interlinked each other. Okay, just like a chain. Okay, so that is why we are calling these as options strikes, which are interlinked to each other. So that's why we are calling the option chain. If markets goes from 25,450 to 25,000, 25,550, so they are just interconnected to each other. So right now a strike difference is 50 here, and in Bank Nifty 100 is difference is there, and in some other stocks we have a differences about odd numbers like 10, 20, like 30, 40 numbers are the strike difference are there. So this all the strike differences, all this like arrangements are done by the like margin rules purpose, and we are not going to go long in that one. Okay, so you got to know about what is right now option chain. Very basic thing. What is it call and put? What is in the money, at the money, OTM. Okay, so you can see right now also option chain, how does it work? Okay, and I can show you this side. Okay, bullish bets are going to happen on the call side. Okay, bearish bets are going to happen on the put side. Obviously you know that. Okay, there is a even bid and ask price on what prices the like buy and sellers asking for. So all those things, out of the money, at the money, in the money, we have just studied right now. So next, okay, so in option chain you are how to check that. Okay, what's the underlying asset? Right now we have studied about Nifty, so it can be stock, ETF, or commodity. Anything can be. Even in crude oil also you can trade in options also. Yeah, option type can be or call or put, and strike price, which is you going to try about expiry date, whether you 20th expiry or 28th expiry. And for Bank Nifty and even some other indexes, we have monthly expiry. Other than Nifty and Sensex, you have to check those all things. Okay, fine. Next you are going to see about what actually you are seeing. Okay, with that you are going to study about key information data like delta, gamma, vega, and theta. So we are going to go very deep in that, but before that we have shown that what all these is a structure. How does it look? Okay, what is the call price, what is the put side, what is the date of expiry? All this is a structure you should understand while you are studying it. In the money, at the money, all those data. Okay, so with that you have to see. Okay, we have two main types of options: the call options, okay, put options. When you want to buy, when you want to sell is a main type of question here. So option buyer has a right to buy at a predetermined price. So whereas option seller in the call side, if you are put side, it has an obligation to sell at a predetermined price. Okay, so this is what we have seen in the two types of call and puts. Okay, what is option buyer? Okay, he has a options contract to buy. He has a right to buy that, and whatever the price he's paid, that is his a loss. I repeat here, 50 rupees option he is buying. Okay, lot size is 75. This is only a loss he has to bear about, not more, not less. Okay, so this is what actually he is going to bear. If you are it's an option seller mode, he has a premium that what he can get. That's an example. If I say he has sold about 50 rupees option he sold, so this is a last price which is going to get a profit. Like example, he knows a profit in advance, that is 50 rupees only he's selling, and that is only his profit. Okay, if market goes against him, that like saying 60, 70, 80, 90, he has unlimited risk. Okay, whereas in option buyer side, he has a limited risk because whatever the premium he is going to pay, that only loss he can or she can bear about. Okay, so that's the same difference between option buyer and seller. So let's start understanding what actually clearinghouse does in middle. Obviously you can default so to minimize those situation, and SEBI has created that upfront margin can also be asked. So okay, example for option seller, it's going to be a unlimited risk. So if I say that 50 rupees option I'm selling, they will ask you about 2.2 lakh rupees for option selling price. Whereas option buying, they can ask about just 50 rupees, means 75, just about I say that around 4,000, 5,000, or depend on the option price value. So you should understand about how the clearinghouse plays a critical role while doing trading of options. Okay, so call option contracts, which they are nominated with C, E, or C in the beginning, or P are called in the beginning of P in the beginning. Okay, so we can understand it easily. So for the purpose to show this one, I can one more point have to show here what's the intrinsic value and what is the time value. Okay, in this first session we are just understanding what is intrinsic value and what is the time value. Okay, so understand here. Right now let's go to the again the practical point now. Okay, we again came to the practical points. Right now see this one here, we have some intrinsic value and a time value. Understand market if it is closes around 25.7 right now. Okay, repeat here, if market closes around 25.7 right now, okay, these all are out of the money and these is all are the out of the money, and they doesn't hold any value after the expiry. They all will become a zero. You understand here, they all will become a zero. And right now if market 25.7 closes at okay at the same price what is I'm talking about at the money, so 25,650 to 25.7, the strike difference is 50 rupees. So 25,650 value would be at the expiry, it should be a 50 rupees. 25,600 value would be 100 rupees. 25,550 value would be 150 rupees. That's what I'm talking intrinsic value. Other than this one, you are seeing the LTP value about 197. Okay, what is that 197? Okay, extra 47 rupees is a time value. In this one also you can see 25,600, you are seeing 56 rupees extra, that's a time value. Okay, 25,650, you have a seeing that 121 rupees as LTP value, you have a 71 or 72 rupees as a time value. That's how, okay, these are all out of money, at the expiry they will become zero. So intrinsic value and time value combination options you are watching right now. Yeah, so look at here other side what I can show you. So if market close at 25,700, what is strike difference between 25,750 to 25,700? So 50. What about additional 40 rupees here? That is a time value, it has to go. Okay, and 25,800 as a difference about 100 rupees, it would be about 23 rupees as a theta value as a time value. Okay, 2500 obviously 200, so it can add plus 3 rupees there. So it is at a like exact value where you can buy into. Okay, so that is what I'm just talking about. Okay, so you got to know about what is the intrinsic value, what is the time value. Let me show you a practical example how these are going to be calculated. Let me start. I'm using Obstra for a purpose to teach you here. Let me take 20th October expiry. So if I'm buying 25,700 rupees, understand here, if I'm buying 25,700 rupees, so if market, okay, doesn't want to lose, if you don't want to lose 89 rupees, market has to close 25,700 plus another 90 rupees, so that whatever premium you paid to, that will become safer. You understand? If you don't understand, come to the PR. Let me show here. So look at here, break even, it's showing about 25,790, right? What I had done, simple, 25,700, just added a 90 rupees and that became into a break even. So before that only you are going to get a profit. That is what I'm talking about, what you're seeing here. Okay, the blue line what is showing right now, T plus 0 P&L. Okay, if market goes about 25,750 tomorrow only, so I'll be getting about 2,340. But if you hold till expiry, you will lose about Okay, so that is what I'm talking here. If market goes above 25,800 or odd, you will have in okay minimum profit. Okay, and your premium will be safeguarded. That's what option buying. So what if you have done simple? Okay, if you add just a premium, you will get a break even. That's what I'm talking. So if you are just thinking that I will buy out of the money, so like example 25,900 I will buy. So do you think that market will go about 25,916 or 917 so that your premium will become safeguarded? So do understand 25,917. If market goes about 25,917, then only your premium will remain same to same, or more than 917, you will make unlimited profit. Yeah. So if market doesn't go 25,917 above or stays below 25,900, you will lose out all this premium. What are you going to pay? Just as it is simple, right? So how you calculate a premium? By adding. How you calculate the break even? By adding a premium. So many people that think that, okay sir, I'll just buy out of the money which are cheaper in the price, so that I can buy a bundle. See, I can buy in a bundle, so I can buy 10 lots, 20 lots. Not like that. You have to buy which are in the money, which have a value, so that even if after the expiry, it has to have a some actually premium. Otherwise they should give a profit. Example, let me buy 25,600. See, I have a break even 25,757. If market crosses 25,757, my option premium paid is safeguarded. First, number one. And thereafter that, I will have a profit also. So for that purpose, we are teaching everybody that, okay, go and buy in the money options. Okay, you'll have a good and break even here. Though you are watching here that, yeah, I will be having a max loss. No, not like that. If you are ensured about that market will go upside only, I prefer you to go for in the money options. That's what I'm talking, because market stopped around 25,700 and we are buying 25,600 call. If you're thinking market will go down, then what we'll do, 25,800 you're going to buy, correct? Okay, you just buy in the money, 100 points in the money in a put side. So just add 25,800 to the premium value, you will get a, so you minus it, you will get a break even. 25,800 minus 123, that what is a break even if you are going to get a profit here. Okay, market. So that is 25,676, right? If you're going to buy out of the money, that's 25,500, then your break even could be around 25,480 order. Below that only you will get a profit. And where is the market standing right now? 25,700 order. And if you think that probability will become high, no, you see this just 18%, right? If you go same, buy at the money, like in the money, just see this one, in the money 2500 I will buy, put. Okay, so 200 points below, and see this one, probability has jumped. This is what as a hack I'm talking about. If you buy in the money, you will have a higher probability. If you buy at the money, you have a 50% or less probability. If you buy out of the money, you have very, very, very less probability. Though you might be lucky if market goes very gigantic moves, then only, otherwise you will have a be only lucky player. So I don't want you to be lucky player. Just understand how the options are going to be play here. Okay, so do you understood about the call side, put side, everything right now? Okay, and how the break evens are calculated, which strikes you have to buy, all those things you should understood, and I think you are understanding right now. So this is what the series we are putting it in English only, and some series we are going to put in Kannada also. Okay, I hope you are understanding the what we are talking about, options, basic mode, what is it called, what is a put, and which strikes you have to choose about two. So for the purpose to again go to the option chain, okay, let me show you here. So in all situation, if you are long in the market, like, yeah, so market will go bullish, in that situation, just if market is trading at 25,700, just go to in the money, ITM one option, 25,600 you can buy into, 25,500 you can buy into. If you think market will go down, like it will go bearish, don't buy out of the money. Just think that you are going to buy 25,800, 25,900 or 26,000 strikes also, only because they have a higher intrinsic value and they will not give you any problem, and your break-even will become stronger and probability become stronger. If you want to see about what are probability and all those things, we are going to study in the next session, like our next video. That is what a delta talks about. So for intro purpose, just I'll tell you, delta is a probability. So see this one, if you're buying 25,450, the delta is still saying that 13% your probability of option buyer. So if you are buying 25,800, you have a 66% chance that yes, you are going to make a profit here, put side. So if you are buying like that 25,900, you have about 82% of like option buyer have a probability of making a profit. If you're on the call side, you are buying a bullish side, then you think that 25,600 has a 71%. Yes, it makes money. Okay, so that is what a delta is all about too. Okay, and anyway, delta about to all those three data will go another big picture here. So I'm stopping here to show you that what is a basic thing about a call and put, and you have just came into the picture now. So just an introduction right now, you got to know about call and puts, and you know now. Okay, so any doubts regarding about whatever you just talked here, you can put into the comments so that we can answer you in a clear way. Anyway, the hatred would be around our all society. Yes, of course, it will be there in comments also. I accept a friendly suggestions from you all so that you can learn more and more here. So being a believer trader community, I want you have to support and learn, at the same time engage in yourself of learning and fighting in the learning situation, not for the like garbage kind of abusive words. Okay, anyway, you have understood a good things here about call and puts. If you have any doubts, do put in the comments and we will discuss it. If you like video, please do like, share and subscribe. Okay, thank you very much right now.